All right.
Hello and welcome. Today, we're going to dive into a topic that is just so important for so many Canadian business owners. The big question is, how can you claim your Lifetime Capital Gains Exemption when you own your active business through a holding company? Now, this is a super common setup, but it makes the rules for the exemption a whole lot more complex. So, let's get right into it.
Here's how we're going to break it all down. Think of it like a qualification gauntlet. We'll start with the main question everyone has, and then we're going to run through 4 critical tests you absolutely have to pass: connection, share ownership, corporate control, and asset usage. And then at the very end, we'll talk about a crucial distinction: whether your setup is just viable or if it's actually favorable for you. Okay, let's start by painting a clear picture of the scenario we're talking about. You've built a successful, active business, but you don't own the shares directly. Instead, you own shares in a holding company. And that holding company is what owns the shares of your operating business. And now, the time has come to sell.
So this is the fundamental question. You sell the shares of your holding company, you have a nice capital gain. Can you use your Lifetime Capital Gains Exemption to shelter it from tax? Now, the key phrase here is that you must sell the holding company. If you just sold the active business from inside the structure, the gain would flow to the holding company. And of course, a corporation doesn't get an LCGGE. That's for individuals like you.
And, as is almost always the case in the world of tax, the answer is it depends. It's not an automatic yes. To qualify, your entire corporate structure has to make its way through a series of 4 pretty tough, very distinct tests.
So we're calling this the 4-test gauntlet, and you have to pass every single one. No skipping ahead. We'll look at them in order. First, the relationship between your 2 companies. Second, who's actually allowed to own the shares. Third, the Canadian control status of these companies. And finally, what their assets are actually being used for. All right, let's jump into our first challenge, the connection test. This test is all about the formal tax relationship between your holding company, which we'll call Holdco, and your active business, which we'll call ActiveCo.
For the tax rules to work, these 2 companies need to be what's called connected corporations. Now, the really important thing to understand here is that this test is like a snapshot. It only matters at the precise moment you sell your Holdco shares. This actually makes things a bit simpler because you don't have to worry about the past 24 months like we will for some of the other tests.
So how do you make this connection? Well, you've got 2 ways to do it. The first one, option 1, is super straightforward: direct control. Your Holdco owns more than 50% of the voting shares in ActiveCo. Done. Simple as that. The second way is what we call significant influence. For this one, your Holdco has to own shares that give it at least 10% of the votes and represent at least 10% of the company's value. You need both. If you meet either of these conditions right at the moment of sale, you pass test 1.
Okay, deep breath. We're now at what is, without a doubt, the most complex hurdle in this entire process: the share ownership test. The reason it's so tricky is that we're looking at 2 different companies, the Holdco and the ActiveCo, and we have to check them across 2 different time periods: the moment you sell and the 24 months right before that sale.
Let's break this down, just focusing on the shares of the holding company for now. As you can see, you or a related partnership are fine to own the shares at any time. A spouse can own them too. But notice that at the time of sale, there's a note about attribution rules. That usually means the shares were transferred in a way that the capital gains to legally attributes back to you. Now, here's where people often get tripped up, that last row. Other related people, say your child or a parent, they could have owned the shares during the 24-month look-back period. But, and this is critical, they cannot own them at the moment of the sale itself. Why? Because the capital gain has to be your gain for you to claim your exemption.
Okay, so this brings up a really good practical question. You might be thinking, wait a minute, what if I only set up my holding company a year ago? It hasn't owned the active business for the full 24 months. Am I automatically out?
Well, not necessarily. The good news is the rules thought of this. If the Holdco is new, we just look at who owned the ActiveCo shares before they were put into the Holdco. That previous owner had to have been you, a person related to the Holdco, or, and this is where it gets really, really technical, someone related to a person who is also related to the Holdco. Honestly, that last one is so complex that if you think it applies to you, that's your big flashing sign to say, okay, I need to call my tax professional.
Phew. Okay, we made it through the hardest part. Test 3. Corporate control is, well, it's a breath of fresh air after all that complexity. This one is pretty simple. It's all about making sure both of your companies are and have been Canadian for tax purposes. The specific label we're looking for here is Canadian Controlled Private Corporation, or CCPC.
So what is that? Basically, it's a private Canadian company that is not controlled, either directly or indirectly, by non-residents of Canada, by public corporations, or, some mix of the two.
And listen, there is zero wiggle room on this one. It is an absolute rule. It has to apply to both your holding company and your active company, and it has to apply across both time periods we keep talking about, at the exact moment of sale and for the entire 24-month period right before it. If either company slips out of CPCC status for even a day, you're disqualified.
All right, we are on the home stretch now. This brings us to our final hurdle in the gauntlet, the asset usage test. So we've confirmed the ownership, we've confirmed the control, now we have to look at what these companies actually own and how they're using it.
So right at the moment of sale, the rule is very strict. It's often called the all or substantially all test. What it means is that at least 90% of the fair market value of the assets in both companies must be used mainly in an active business. This means you can't have a bunch of passive stuff sitting around like a big pile of cash or a stock portfolio in either company.
But for the 24-month look-back period, the rules actually get a little more flexible, which is nice. We switch from that strict absolute test to a more conditional one. Its official name is the Modified Asset Test.
And this table shows the trade-off perfectly. It's kind of like a balancing act between the two companies. You've got two ways to pass. So look at option 1. If your holding company is super clean, meaning 90% or more of its assets are active, then the active company underneath it only needs to be over the 50% mark. On the flip side, look at option 2. If your holdco has some passive assets and is only just above that 50% line, you can still pass as long as the active co is extremely clean, with 90% or more active assets. See how that works? One can sort of make up for the other.
So, if you've managed to navigate all 4 of those tests successfully, congratulations, you've made it through the gauntlet. But we're not quite done. Passing the technical tests isn't the end of the story. We have to ask a much more strategic question.
Look, if you meet every single condition that we've just walked through, then the answer is yes. From a purely technical, tax law perspective, your holding company structure is a viable path to claiming the LCGE. You've proven it can be done.
But that leads us to the real million-dollar question, doesn't it? A question taken right from the source material for this explainer. Just because it's viable, is it favorable? Should it be used? The fact that something is technically possible doesn't automatically mean it's the smartest choice for you.
And that's really the final thought I want to leave you with today. Your structure might pass all the tests and qualify you for the exemption, but you have to step back and ask, is this the most favorable structure for my bigger financial picture, for my long-term goals? Answering that question, well, that requires a really deep dive into your specific situation, and it makes getting tailored professional advice not just a good idea, but absolutely essential.